This illustration tracks through the three transactions from the example using both the cost and the par value method. The big picture items to note here: number one, the substance of the transaction remains the same. So as you look at and compare transactions between the cost and the par value method, notice that the cash flow is the same. The economic reality of this transaction or any other transaction is not affected by the accounting method that's selected to reflect that on the financial statements. Secondly, notice that the net change to stockholders' equity is the same. Whether the total dollar amount goes to treasury stock or is split between a variety of stockholders' equity accounts, the big picture change to stockholders' equity remains the same, and it's going to be the amount of cash that was received or paid in the transaction. One other item: with the cost method, the balance in treasury stock is going to be shown on the balance sheet as the last item in stockholders' equity. And the reason for that is this method allocates the fair market value or the cost of the shares to treasury stock. Sometimes that dollar amount can swamp the rest of stockholders' equity, so on the balance sheet it's shown as the last item. If a company elects to use the par value method to account for treasury stock, the treasury stock has the par value of the shares sitting in that treasury stock account, and it would be netted against common stock on the balance sheet. At this point, we're going to turn our attention to retained earnings, which is the second source of stockholders' equity. Remember that retained earnings is sometimes called earned equity, and it represents the company's earnings that have been accumulated and not paid out to the owners in terms of dividends. This graphic shows a retained earnings T account, and since retained earnings is part of stockholders' equity, it increases by crediting it, or it would decrease with debits. So the debits are items that decrease retained earnings, credits increase it. So we talked about net income increasing retained earnings, or net loss would decrease it. Distributions to stockholders are another decrease to stockholders' equity. A transaction that we'll talk about in a subsequent chapter is correction of errors. Those can increase or decrease retained earnings, and some of the treasury stock transactions that we just covered can decrease retained earnings. This graphic reviews the three dividend-paying event dates. First is the declaration of the dividend. This is the time when the board of directors has made the decision that they're going to distribute some corporate assets, typically cash, out to the shareholders. It's that decision that initiates the accounting entry where we debit retained earnings and credit the dividends payable. The effect of that on the accounting equation is two offsets within the right side of the balance sheet. Liabilities are increased while stockholders' equity decreases. The record date is the date that the shareholder must be shown as the owner of the stock to receive the dividend. Important if you're the shareholder. For the company, not important, and it doesn't affect the total amount of the distribution. The payment date is the date that would be subsequent to the record date when the company actually pays that liability. Notice the accounting entry: we eliminate the dividends payable and we credit cash. The effect of that entry is to reduce assets and to reduce liabilities. Overall, the net effect of these transactions is that the dividend distribution lowers assets and lowers stockholders' equity. Stock dividends are a distribution of additional shares of the company's stock to the shareholders. There is no change in total stockholders' equity. We're going to move dollars around within stockholders' equity, but the total will remain the same, and all shareholders will receive the same percentage increase in their shares. For accounting purposes, we will break stock dividends into two categories. A small stock dividend is a distribution of less than 25% of the company's shares. These distributions are recorded at the fair market value of the stock issued. So this transaction, the company will reduce retained earnings for the market value, and they will increase contributed capital for market value, splitting that market value between the par value of the shares issued and additional paid-in capital. The second category of stock dividend is a large stock dividend. and that's a distribution of 25% or more of the company's capital stock. These are recorded at the par value of the stock issued. So this transaction would be a debit to retained earnings for the par value and a credit to common stock or capital stock for the par value of those shares. Notice that both transactions reduce retained earnings, increase contributed capital. There are two approaches that can be used to accounting for stock splits. The first is where the company proportionally adjusts the per share par value of the stock. So in a 2-for-1 stock split, the par value of the stock would be decreased to a half of what it previously was. The other approach, and probably the more common approach, is that the company does not change the par value per share. However, what they do is they transfer dollars from either contributed capital and additional paid-in capital or retained earnings in an amount equal to the par value of the shares that are issued in the split. Regardless of the accounting method used for the stock split, under both approaches, the number of outstanding shares increases. In fact, that's the whole point of the transaction, and there is no change in total stockholders' equity. We'll use the following example to illustrate accounting for a stock dividend in a stock split. In this example, Sunshine Company has $600,000 of common stock, which is comprised of 3 million shares of issued and outstanding common stock with a 20-cent par value, $3 million of additional paid-in capital, and $10 million of retained earnings. First, we'll assume that the company declares and issues a 10% stock dividend. This is a small stock dividend, so the company will be issuing 300,000 shares. We'll value those shares at the $25 fair market value. 300,000 times $25 per share gives you $7.5 million, which is the debit or the reduction to retained earnings. We're going to increase contributed capital by $7.5 million. Also, the par value of the shares issued, or 20 cents for each of those 300,000 shares, goes to common stock. The difference, or the rest of the value, $7,440,000, is recorded to additional paid-in capital. This example, the company decides to declare and issue a 100% stock dividend. So they're going to double their number of shares that they have issued and outstanding. So the company goes from 3 million to 6 million by issuing another 3 million shares in this 100% stock dividend. The size of the stock dividend means that this will be considered for accounting purposes a large stock dividend. So the 3 million shares issued multiplied by the 20-cent per share par value to come up with the $600,000 reduction to retained earnings. That $600,000 is the par value of the shares issued, so we credit common stock for that amount. This transaction effectively reduces retained earnings by $600,000 while increasing contributed capital through common stock by the same amount. Total stockholders' equity is unaffected by this transaction. To complete the example, this shows the company making a decision to declare and issue a 2-for-1 stock split. The effect of this transaction will be the same as the 100% stock dividend. The company will be issuing 3 million shares of stock to the current shareholders. The total number of issued shares will jump from 3 million to 6 million. However, a difference between the treatment of the stock split and the stock dividend is that there's no journal entry to be made. The par value will be split in half to reflect the new issuance of shares. So the old par value was 20 cents for the 3 million shares. It's going to drop to 10 cents for the 6 million shares. The company opts for the second approach to accounting for a stock split, where the per share par value remains the same, and they transfer dollars from contributed capital or retained earnings to common stock. In this scenario, the company is issuing 3 million shares of stock. Par value remains at 20 cents per share, so they would debit or decrease either additional paid-in capital or retained earnings for $600,000 and credit common stock. Notice that this entry is virtually the same as that we made for the 100% stock dividend. And that's why this approach is often referred to as a stock split affected in the form of a dividend. So we'll wrap up this chapter with the comparison of GAAP to IFRS. As you read the next few slides, you'll notice that most of the accounting is the same between the two methods. Some of the terminology does differ between IFRS and GAAP, however.